Okay, there's one last subject I want to talk about in chapter 9, and sometimes I forget to do this, and I'm glad I'm not. But this is in regards to, and they put this at the very beginning of chapter 9, but I don't cover this until we're almost done with 9. And this is in regards to credit card sales, okay? Now, when a company uses, or when a customer uses a credit card, it's not a classic accounts receivable situation, okay? For example, Kyle, you work at Target, okay? So let's say that somebody comes in and buys, you know, a $100 radio or something like that from the electronics department, okay? Now let's say that there's no sales tax, just for our example. Well, if that customer buys that $100 radio using cash, then Target gets $100, right? Okay. However, if they choose to use like a Discover card or Visa or MasterCard, Target doesn't get $100. They get like $98 because Visa or Discover or MasterCard charges a 2% fee for that transaction. Are you with me? Yeah. Okay. You following me? Okay. That's one of the ways credit cards make money. Okay. They're giving Target $98 now, and then when the customer pays the $100, who gets it? Visa or MasterCard, right? It's a little bit like that factoring. Didn't we talk about factoring last time a little bit? It's a little bit like that. Now, Target would rather I pay in cash, would they not?
Seems like it.
Yes. So why don't they just make a policy that says, we're not going to take credit cards. We only take cash.
It just wouldn't work. You'd lose sales because
You'd lose sales, right? True story. A few weeks ago, I was on vacation I went down to Florida with my wife and my son, and we were visiting my other son, and we were going to go to this pizza place. Well, we went into the pizza place, or we were about went into the pizza place. There was this big sign on the door that says, our policy is we do not accept credit cards or debit cards or anything. All we do is cash. We take cash and that is it. And, well, that's fine. They're avoiding those charges, but I just never carry around cash anymore. Is anybody like that? So we just left. I mean, we walked in and walked right back out. They lost our business. So if Target went to a cash-only policy, their sales would plummet, right? So Target is willing to pay that fee, right? Now Target, I guess, if they wanted, could say, "Hey, we're going to sell this radio to you on account. We'll set up an accounts receivable." But then Target has the risk that that person's not going to pay, right? Or they may have to go to the process to check out their credit history and credit rating and all that. So there are several advantages to allowing customers to use credit cards. Let's talk about those, okay? Number one, as it says, cash sales or cash, where does it say it? Oh, right here, top right. Sales increase, right? Or another way of thinking about this is our sales will plummet if we do not offer credit cards anymore, right? You know, you think about a company like Nebraska Furniture Mart, I bet you well over half of their sales are credit card sales, okay? We get our cash quicker, right? We don't have to evaluate the customer, right? If somebody comes in to buy something, that $100 radio at Target, and they look a little sketchy, if they run their credit card and it goes through, Target's in the clear, aren't they? If that person decides to skip out, it's not going to be Target who's hurt. Who's going to be hurt? It's going to be Visa or Discover, right? Okay? So that credit card company, they have taken on the risk of extending that credit to that customer as opposed to the retailer. Are you with me? Okay. So this is a pretty easy deal. Let's look at an example. they walk through these steps, but I think it's better than it's better to not look at these steps and just do an example. On July 16 of 17, Barton Company, that's us, we have a credit card sale of $500 to a customer. Now, the bank charges a processing fee of 2%, and we receive the cash immediately. So, we book the sale for $500. However, we don't get cash of $500. We only get cash of $490, which is the $500 times 98%. And the 98% is the 100% minus the 2% fee. You with me? So yes, we booked the sale for $500, but we only get cash of 98% of that, which is $490. The 2% times $500, that $10, Barton Company books that into an account called credit card expense, right? Make sense? That's pretty simple, isn't it? But this is not a true account receivable situation, which is why I don't cover it until we're done with accounts receivable, because I don't want to get people confused. All right?